One of those things you have to worry about when it comes to investment, be it personal or from a firm's point of view, is both capital structure and cost of capital. Hi, I'm Manuel, and in this video we look to answer the question, what is capital structure and cost of capital? When it comes to financing investments in a company, there is always the question of what is the optimal capital structure? Capital structure is simply the mix of both debt and equity finances. The thing is, firms generally obtain their funds from two sources. One, they can either borrow from intermediaries such as venture capital provider and banks, or they can borrow from shareholders, that is, owners of the firm. Making decisions regarding the optimal capital structure, that is, the best finance mix of both debt and equity, is not straightforward. And so in most cases, managers will often opt for the decision that will give the shareholders more wealth. The ratio of borrowed funds to total funds is known as gearing ratio. There could be two outcomes in relation to this. A, the firm is highly geared, in which case it has a large proportion of funds borrowed from intermediaries in relation to its share capital. Or B, low gearing, which occurs when the bulk of borrowed funds is from shareholders. Note, the higher the level of capital gearing, the greater the risk associated with the company. Cost of capital, on the other hand, is the rate of return that a firm has to earn on its investment project in order to maintain the market value of its shares. The other way to look at it is that it's the rate of return required by market suppliers of capital so as to attract their funds to the firm. Note that if the level of risk is held constant, the project whose rate of return is above the cost of capital will increase the value of the firm, unlike those with lower rate of return whose effect will be to decrease the value of the firm. The cost of capital has two aspects to it. Number one, cost of funds that the firm raises and uses. And number two, the return that investors expect to be paid for putting capital into the firm. It's therefore the minimum return that a company should make on its own investment so as to earn cash flow out of which investors can be paid their return. For instance, when a shareholder invests in a firm, the returns they obtain must be sufficient to persuade them not to sell some, if not all, of their shares and invest elsewhere. The yield on the shares can therefore be considered as the opportunity cost to the shareholders of not investing elsewhere. I hope you have a clue as to what capital structure is as well as cost of capital. In the next video, we will look at how they can be calculated. Let me know your thoughts on the video. Also, feel free to support ZERITE Network on Patreon. The link is in the video description. Do have a lovely day.